Welcome to this explainer. Okay, today we are diving into some source material that outlines what is, honestly, probably the biggest macroeconomic shift of our entire generation. We're going to pull back the curtain on the actual structural plumbing of the market, and more importantly, we're going to unpack a highly actionable, specific playbook for navigating it, which we're calling the 3 phases of wealth. Let's get right into it. Right off the bat, the data points to an absolutely staggering number. Look at this, $8.9 trillion. According to the research, the US government is quietly facing an $8.9 trillion refinancing wall. And to put that into perspective, this isn't some distant projection for the next decade. No, this is debt maturing over the next 12 months. It literally represents the largest concentration of maturing debt in human history.
So the crucial point is, over 28% of all national debt has to be completely rolled over in just the next 300 days. And here's the real kicker. They're having to trade in their old near 0% interest rates for today's rates. That means they are doubling or even tripling the carrying cost of that debt. It's wild.
So here is our roadmap for today. First, we'll look at the hidden liquidity drain. Second, the draining pool analogy. Third, separating viral noise from structural reality. Fourth, the broken 60-40 strategy. And finally, the core of our explainer, the 3 phases of wealth. Okay, let's dive into part 1, the hidden liquidity drain. You see, to fix this massive debt issue we just talked about, central banks are quietly pulling liquidity out of the banking system at the absolute fastest rate since 2008. But you might be wondering, where exactly is that money coming from? Well, the sources point directly to everyday stock market gains. If you've been sitting there scratching your head wondering why your tech stocks are violently swinging around, or why your broad index funds have just kind of stalled out despite glowing earnings reports, this is it. Capital is literally being siphoned right out of everyday portfolios. Moving on to part 2, the draining pool analogy. Let's visualize this. Think of the market like a giant neighborhood pool. For the last 15 years, it's like a local water plant has been pumping free, cheap water into this pool every single night. Because the water was so incredibly deep, investors naturally built taller and taller diving boards, which represent sky-high tech valuations and risky speculative growth companies. But today, there's a massive fire across town, our government debt wall. So the water plant drops a giant hose in and starts pumping water out of our pool to go fight that fire. The water level drops rapidly. Suddenly, jumping off those high diving boards isn't just risky, it's a guaranteed belly flop. That water is global capital liquidity, and central banks are siphoning it out to pay staggering interest bills. That brings us to part 3, viral noise versus structural reality. Let's separate the facts from the fiction. Now, what's really interesting about this slide is how it cuts through the panic. Viral financial media absolutely loves to claim there are secret Fed mandate laws or imminent banking collapses, mostly just to farm clicks through fear. But when we actually look at official central bank balance sheets and primary dealer data, the structural reality is a lot more mundane, though absolutely crucial to understand. There is no sudden apocalyptic crash coming. Central banks aren't trying to break the system. Instead, it's just a slow, grinding capital migration. Massive institutional treasuries and sovereign wealth funds are quietly rebalancing. They're taking billions out of over-leveraged US growth equities and shifting it into high-yielding real assets and non-dollar bonds. All right, part 4, the broken 60-40 strategy. The old rules are failing us. For literally 40 years, the 60-40 strategy was the gold standard, right? You keep 60% of your money in stocks for growth and 40% in government bonds for safety. But during a liquidity drain caused by debt refinancing, well, that entire relationship shatters. As the data shows, both paper stocks and traditional paper bonds drop in tandem. Why? Because for the last decade, both of them were artificially inflated by the exact same easy money. I just absolutely love this quote from our source material because it hits the nail right on the head. You cannot use the old rules to navigate a brand new era. Relying on old diversification rules right now is literally like using a map of New York to try and navigate Tokyo. You're going to get lost. We need a completely different strategy that respects the reality of this macro pivot. And that brings us to the ultimate solution. Part 5, the 3 phases of wealth. This is your new playbook. And this brilliantly illustrates exactly how to handle this transition instead of getting caught completely off guard. The overarching framework breaks down into 3 very distinct steps: capital defense, hard asset allocation, and capitalizing on capital migration. Let's explore how the research suggests executing each one, starting right at the foundation. So, phase 1 is all about capital defense and deleveraging. The strategy suggests you gotta audit your portfolio for assets that are priced for perfection. You know, the ones relying on constant cheap debt just to keep their valuations afloat. The research heavily emphasizes eliminating margin right now, because actually, scratch that, margin isn't just risky, leverage is exactly what turns a temporary market pullback into a permanent, devastating capital loss. Instead, the playbook points to storing your extra capital in short-duration treasury bills or liquid cash. And with yields sitting around 4 to 5% right now, you're getting paid to wait. Plus, it gives you the ultimate flexibility to scoop up world-class distressed assets later when everyone else is completely out of cash. Moving on to Phase 2, hard asset allocation. Because paper money is facing structural inflation from all that government debt, the data shows central banks know this better than anyone else. I mean, they are buying record amounts of physical gold and precious metals right now. To anchor your portfolio while paper markets reprice, the research suggests a tactical allocation in hard assets. This means things like commodity indices and utilizing defensive, dividend-paying engines in sectors like healthcare or energy. And finally, Phase 3. This is where wealth is truly accelerated, capitalizing on capital migration. As global liquidity shrinks, the material highlights massive tailwinds for specific sectors. We're talking global value and multinationals. These are huge companies with massive cash flows and very low debt. We're also looking at commodity producers dealing in real assets like copper and agriculture. And interestingly, the data points out that when truly phenomenal technology companies dip purely because of the broad market liquidity drain and not because their actual business fundamentals are bad, well, that creates a genuine, generational buying opportunity. Now, for those of you who really want to get into the weeds and track this data mathematically, the source material includes a free global liquidity tracker that breaks down these central bank flows. They're also hosting a live workshop to explore exactly how institutional desks position their portfolios weeks before these massive macro moves even occur. It's just a fascinating way to look past the headline noise and see exactly where the data is pointing next. Well, we have definitely covered a lot of ground today, but honestly, it all comes down to the single, undeniable reality. An almost $9 trillion debt wall is forcing central banks to drain liquidity right out of our paper markets. The old rules, they're obsolete. But a very rare window is opening up to buy world-class assets at a massive discount. The investors who build true generational wealth are the ones who understand these mechanics and act well before the crowd does. So I'm going to leave you with this final provocative thought to consider today. Look really closely at your investments right now. Is your portfolio built for the full pool or the drought? Thank you so much for learning with me today, and I'll see you in the next explainer.